Hello and welcome to the Market Mosaic, where every week we are looking at macroeconomic data, the stock market's technicals, and market internals, things like sentiment and breadth, to try to come up with an idea where the market could be heading over the near term. And for this week, look, it's going to be all about the Fed. The Fed will conclude its latest rate-setting meeting this week, widely expected, to kickstart the rate cutting cycle here once again. So the Fed cutting rates by about 1% late last year. Since the December meeting, the Fed has been on hold now for about 9 months and widely expected to start cutting rates again. And so let's get into the reasons why they can cut rates. First, it was all about inflation last week not being hot enough to derail hopes that the Fed can start to cut. So last week, we had the consumer price index came in at 2.9% in August compared to last year. The core figure that strips out food and energy prices increased by 3.1%. So this orange line is core. This blue line on here is the headline figure, again, increasing by 2.9%. Here's the thing. Both measures remain well above the Fed's 2% target. The disinflation trend off the inflation wave that peaked into mid-2022, that is stalling out. So you can see that in the chart here. This orange line of core CPI has stayed right around this 3% level really since about June 2024. And, if anything, we're starting to see core inflation inflect higher here recently. And so, look, inflation remains a problem for the Fed. But the thing is, the central bank's focus has clearly shifted toward supporting the labor market. So the focus has moved away from the inflation and price stability mandate and toward the labor market mandate. And that's because the August payrolls report, we know that missed estimates with just 22,000 jobs created during the month. But now we're seeing the negative revisions to prior data keep stacking up. So we had a absolutely massive record-setting downward revision to initial payroll estimates for the year ended in March. So the Bureau of Labor Statistics came out and they made their preliminary benchmark payrolls revision that reduced job growth by 911,000 jobs, again, for the year ended in March. And so the weakness in the labor market and the Fed's shift in focus there, that has the market pricing several rate cuts ahead. So we've got market implied odds pointing to 5 quarter-point rate cuts over the coming year. We like to use the 2-year Treasury yield to look at where the Fed funds rate could be going. It's suggesting around 3 to 4 cuts. So there are definitely cuts in the future, and the market's pricing a 100% chance that the Fed is going to reduce rates when they meet this week. The only question is by how much. There's speculation that they might actually come out and do an outsized cut of 0.5%. So look, either way, a new rate cutting cycle is set to begin at a time when financial conditions are already loose and the stock market is signaling a positive growth outlook. So for this week, to get ready for this week, I want to look at evidence that the CPI report shows that inflationary pressures are actually continuing to build. And because of that, why the Fed funds rate backdrop is very remarkably similar to what we saw in the late 1990s. I also want to look at why the market is continuing to climb, call it this wall of worry. There's still a lot of bearish sentiment. And the conditions that are in place right now to spark yet more upside in this bull market, despite the recession fears that are starting to increase because of the payrolls data. All right, so let's take a look at the most recent CPI report that came out for August. Investors liked the report because there was a lack of upside surprises in CPI. The figure mostly came in line with economists' estimates. And again, that's giving the Fed an all clear to start to cut interest rates here again. But there are some big problems lurking in the CPI report. Underlying core CPI components are showing that inflation pressures are continuing to build, and that could lead to rising inflation in the months ahead. So the chart on here shows a couple key components of core inflation. So What I want you to notice is that core goods, this line on here, core goods tends to move first, and you've already seen it inflecting higher. So we see this line moving higher. That tends to be followed by core services X housing. That's also called super core, and it's this light blue line. It's been an overall downtrend, but you can see in recent months that's starting to move higher. And then the last core component that moves is this housing figure. This darker blue line tends to move last. And you can see it's starting to stall out with the disinflation trend. Look back at these past instances. I mean, look, back into the last inflation wave we had in the mid-2022. You had core goods go first, then super core, the light blue line, followed by shelter. So again, you need to watch how these dominoes are falling, because right now they're pointing to the disinflation trend that is either stalling out or you're already starting to see these lines move higher. All right, so the backdrop for the Fed funds rate and what the Fed is getting ready to do here, it shares very remarkable similarities to what you saw unfold in the late 1990s economic boom in that period and the internet bubble that we saw as well in the stock market. So back then, just look at how this played out and look at what's happening today. Back then, the Fed cut rates by 1% starting in 1995. So here's that 1% overall reduction in rates. Held rates steady after that. So look at what's happening today. We had the Fed cut rates by 1% in late 2024 and has held rates steady since then. Okay, now back to this chart. In 1998, the Fed started resuming rate cuts again. It was about another 1% reduction until they were forced to reverse those cuts in 1999, and that helped cause the recession, which is this, you see we tightened into this recession, the shaded area, and that popped the internet bubble in stocks. So we could see a similar scenario unfold this time around, because if we see the inflationary pressures build into next year, if the economy avoids recession and keeps growing, that could ultimately limit the number of rate cuts that the Fed could do and lead to a fresh round of tightening. Now, here's the remarkable thing about the Fed preparing to cut interest rates. They are getting ready to cut rates at a time when financial conditions are already running much looser than average. So financial conditions, that reflects the availability and cost of credit. When credit is cheap, when credit is plentiful, that tends to be a tailwind for economic activity. That helps the earnings picture as well, and so that's a tailwind for stocks. The Chicago Fed, the Fed's Chicago district has their own measure of financial conditions, and it's at the loosest level since 2022. This chart on here shows Goldman Sachs's global measure of financial conditions, and you can see right now it has eased to the lowest level in 12 months. And so here we are, we're restarting the rate cutting cycle, which could be another tailwind for easing financial conditions. All right, so interest rate cuts by the Fed often precedes recession because the central bank acts too late in response to a weakening economy. It's not necessarily the Fed's fault, it's due to their mandates. The Fed's mandate spans lagging economic indicators like the labor market. The labor market is among the last things to turn when the economic dynamics are changing. Same thing with inflation. And so the Fed tends to be too late, but the stock market tends to lead changes in economic activity. And as often, the market, the S&P 500, is often coming off its peak by the time the Fed starts cutting. But when the Fed cuts and the S&P 500 is within 2% of an all-time high, then you tend to see positive forward returns for the S&P. So that's what this table is showing. This shows when the Fed has cut interest rates when the S&P 500 is within 2% of an all-time high. Now, there's a couple things to note on here. Over the next month, things can be a little dicey. You can see some negative numbers on here, some large negative numbers on here. And the percent of time the market's higher is only 50%. But as you start to take a longer-term horizon looking further out, the next 3 months, 6 months, next 12 months, you have pretty strong average and median gains along with a high win rate. Looking out over the next year, you have a 100% win rate with an average gain of almost 14%. So again, this bodes well for the market when you have the Fed cutting interest rates and the S&P 500 is near an all-time high. The S&P, it's setting more record closing highs over the past week, but here's the thing that's really interesting. Investor sentiment is nowhere near bullish extremes. Usually when you have the market going on the epic rally, the epic run that it's seen since the April lows, it's easy to get investors to become too bullish, and that's a contrarian indicator, but we don't have that across a lot of sentiment indicators right now. If anything, several measures of sentiment show that fear is the prevailing emotion. So take the AAII, their survey of retail investors. They do this once a week. Their survey last week showed bearish views at 49.5%. Bullish views are just 28%. So bearish views easily outnumbering bullish views. Those bearish views are also well above the historical average, which is 31%. But then the other thing too is you can look at, so that's how people feel. That's a survey asking about feelings, but you also want to look at positioning data. You want to look at how investors are actually positioning in their portfolio. And that's what this chart does. This chart looks at large speculators, a category called large speculators. It's going to be things like hedge funds, and how they're positioning in stock index futures. And you can see it's leaning bearish. You can see in this chart that large speculators are collectively net short. They've moved to this net short position below 0%. So they're betting on their position for a decline. Large speculators are collectively net short across stock index futures, which again, this is a contrarian signal. So because this is betting on the downside as a contrarian signal, this is a bullish indicator. And so again, we're seeing various measures of sentiment or a tailwind for stock prices. And so that's why we like to say the market right here is climbing a wall of worry. All right, just taking a look at key upcoming events this week. We're going to get some economic data, pay close attention to retail sales and how this could influence estimates for quarter GDP. But the big thing is going to be this Fed interest rate decision. So the Fed starts their meeting on Tuesday. They'll conclude it on Wednesday. And look, widely expected to cut rates. The Fed's pretty much cornered themselves into cutting rates at this point. The only question is, do they do a quarter point rate cut or go for something even larger like a half a point rate cut? And then pay close attention to what Fed Chair Powell says in his press conference, and his comments on the outlook will be a big driver in terms of influencing the markets on what the Fed is expected to do ahead, the magnitude and number of rate cuts that could be in the future. So pay close attention to what Powell says in that press conference. Let's take a look at some stocks that are on the move this week in a big way. So we've been tracking what's happening in the quantum computing space for several months now, the bullish chart patterns that have been setting up, and we are seeing some major breakouts to conclude the week this past Friday, and really sets the stage for this sector to go on a big run looking ahead. So the first one I want to look at is with IONQ, ticker IONQ. This looks at the chart setup going back a year. You can see we initially peaked out near this $50 level in January. We had the pullback, rally back to the prior highs. Now this is where the trading action gets really interesting, because you come back, you start making a series of smaller pullbacks for the most part along the way, trading in a relatively tight range given that this is a very volatile stock. But now look at this price action. This price action on Friday, this stock just absolutely ripping above that $50 resistance level on a huge jump in volume down here. And the MACD is in a good spot, pointing to momentum in the early stages of turning higher. So all things are really lining up to support this breakout in IONQ right here. But this is not the only quantum computing name that was on the move over this past week. The other one with RGTI. Now, RGTI showing something similar in terms of the magnitude of its gain on Friday. That's also taking it above a key chart level. So this stock also peaking out in January earlier this year. Made a pullback and then made this a steady grind higher, this higher lows along the way back toward that prior resistance, and started making a series of smaller pullbacks and trading in a relatively tight range. That culminated in this move over resistance on Friday, with the MACD just turning higher above zero, indicating some good momentum that could be in the early stages of good momentum in this name. But the big tip off right here that you're getting a lot of institutional interest in this name is this absolute surge in volume. So we're seeing these massive breakouts in quantum computing names occurring on a sudden burst in volume. That bodes well, in my opinion, for these breakouts looking ahead. All right, that is all for this week.